What sort of funding models, which are backing development lenders, do you think will be most tested or challenged in the current climate?
I think anybody with open-ended funding arrangements, where investors have the ability to make a call for their funds when the underlying investments are really illiquid. They don't even pay current pay because they pick development loans are PIK. So I think that's the most vulnerable funding model. They will ultimately have to be gated in circumstances they can't come up with the liquidity solutions. End-of-life funds, so these are funds that are gated, but they have a definitive end of life and they can't extend any further. One of the trades that we did do a few years ago had that profile. Good underlying real estate, but it had been extended twice after 7 years and funds legally had to be returned to investors. I think any funding model that's a just-in-time model that was dependent on redemptions of existing loan books in order to fund current commitments could become problematic. Commitments don't go away. You can't control those. They're there. Whereas the ability to raise liquidity against redeeming loans or redeeming real estate is out of your control. And that can create some treasury difficulties.
Do you expect to see a change in how development lenders are funded going forward as a result, and in what way?
It'll be a reminder that you must have a matched book. I think in all these situations, it's all okay until it's not okay. And it can be quite dramatic when it's not okay. Because it's not just one loan that it's affected, it can be all loans. I've made mistakes in the past. I've been in a situation in the past where we had commitments to the right and funding to the left, and that funding was pulled. It made life impossible to keep things going to the right. You know, those are challenging situations, and you have to be really inventive as how you deal with that. And it really tests partnerships, it really tests relationships, who's in for the long haul, who's patient, who actually said we're partners in the good times is actually a partner during the bad times. You know, all of that will be tested, and all of that will change the way that I think people think about funding models. And there's nothing like a crisis to pull you back to the fundamentals in our conversation, matched funding. So I do think, to answer your question, there will be a return to more, I'm not saying traditional models, the market's extremely dynamic, but I think that this is a home for capital that is long dated. Okay, this is not a home for capital that needs immediate liquidity. If you don't have the patience, you really shouldn't be in this kind of business, because a development loan can fast become a long-term loan. And if you don't want to crystallize your loss, you have to be able to transition your capital to move in that direction. And in that regard, I think money such as pension money, insurance money, endowment money, superannuation money, that's the kind of funding that's needed in a development loan. Even if the development you think is only 2 or 3 years, it can become 5 years, right? And you need to have that follow-on capability, otherwise you crystallize your position.